All right. So we have seen the basics of budgeting, different types of budget setting processes, all that we have seen. Now let's try to do a couple of questions here. So this is a question on rolling budget. Rolling budget is not a regular type of question in section B, but when it comes, students don't usually answer very well. Not very bad also, but they don't score really well in rolling budgets. Let's have a look at this question. Bay Company uses a system of rolling budgets. The sales budget for the year to 31st December 23 is as follows. Okay. Quarterly they have the budget and total. Actual sales for quarter 1 were 117,879. Okay, this figure, they have the actual figure now, 117,879. The adverse variance is explained by growth being lower than anticipated and the market being more competitive than predicted. Senior management has proposed that the revised assumption, there you go, the assumption changes. Revised assumption for sales growth should be 5% per quarter. Update the budget from Q2 based on the above information. Right. Now let's take this to Excel. Let me copy this data. Let's go to Excel. All right. Now, new budget is going to be like this. Let's see. Q1 is finished. So, anyway, I'll write Q1 also. Q2, Q3, Q4. Then I will add Q1 of next year also. 24. That's the rolling budget process I explained in my last video. What is it? When one accounting period expires, quarter 1 expires, others are updated and one more accounting period is added. Right. Quarter 1 actual was 117,879. This was actual. Let me put it in a different color. Just to say it's actual. That's not needed to answer the question. I mean, you don't have to show this part. Quarter 2 is going to be, what is the new assumption? 5% growth. So take this figure multiplied by 105%. 5% growth means 105%. Done. Then copy this and paste it to other cells. This is how the budget is going to be. So automatically every quarter will have 5% growth. Have a look at that. Every quarter will have 5% growth. Shall we check the answer? 123,773, 129,962. Yes, it goes on like that. Budgeting issues, sources of budget information, past data, sales forecast, production department, costing information. So finding information sometimes might be hard for you. You may need external information. You might need to understand how the market is going to be, how the competition is going to be. There was one past exam question. It asked, explain the sources of uncertainty in budgeting. So there are many uncertainties, how the competitors are going to act in the market. That will decide the price. If competitors enter into a price war, the prices have to be reduced. Right? So your budget might change. One. The availability of technologies that might make your product obsolete. That might sometimes reduce the demand factor. So demand will be reduced. Availability of labor. We estimate a certain level of labor availability, but things might change. Economic factors. You assume a certain economic level, inflation and all you assume at a certain level, if the actual is different. So there are so many areas where budgets are exposed to uncertainties. This was just that one final exam question I'm talking about. Then, allowing for uncertainty. Flexible budgeting. I mean, in this process we have uncertainty. So how do we incorporate uncertainty into budgeting? One option is flexible budgeting. That means the uncertainty with volume is factored by preparing flexible budgets. What is flexible budgets? In my last video I explained different volumes you analyze. Rolling budgets is another way of dealing with uncertainty. Why? You keep updating your budget time to time. That's rolling budget. Probabilistic budgeting. That means taking the probabilities, finding expected values, preparing budgets like that. Sensitivity analysis. Sensitivity analysis means you prepare the budget. Let's say you assume so many factors, you prepare the budget and the budget says profit of 25,000. Now you do a stress test on it. Stress test means if selling price increases, what will happen to this profit? If variable cost increases, what happens to this profit? If fixed cost increases, what happens to this profit? One by one, variable by variable, change them from the assumptions and see what happens to the profit. This is known as sensitivity analysis, kind of a stress test. Each variable, you pull it a little bit from the assumption, increase it, decrease it, and see what happens to the sensitivity, what happens to the NPV. That's known as sensitivity analysis. Criticisms of budgeting: time consuming and expensive. Of course, you need to have a budgeting team. They should know the forecasting techniques and all. So it takes time. Fail to focus on shareholder value. Sometimes, they focus on all these short-termistic measures, whereas finally they forget what they are doing. Remember, we are managers in businesses to generate worth, generate value to shareholders. If it is a profit-seeking business, that's the ultimate purpose. But when we get so busy in such yearly targets and all, sometimes we might forget this. Too rigid and prevent fast response. Sometimes you become so strict about the budget. You give a budget to a manager and you align all his bonuses with the budget. So this manager would not like to deviate at all from the budget. Sometimes the customers demand something, employees demand something. He doesn't want to deviate because his bonuses are linked to the budget. So he becomes too rigid. Protect rather than reduce cost. Protect means, you try to maintain at a certain level. You give a budget and say your expected cost is that much. Anyone achieving that much of cost, they are going to be happy. They will not take further measures to reduce the cost. Stifle product and strategy innovation. Focus on sales targets rather than customer satisfaction. Lead to unethical behavior. Why unethical behavior? Sometimes, people might take shortcuts to achieve the targets. Not the right way. Just because they won't achieve the targets in the budget, they might take unethical approaches. What unethical approaches? Sometimes some basic expenses like employee training, they might cut it, saying that I'm saving cost. It's not really good for the company. In a way, it's unethical. Sometimes they might source materials, they might buy materials from a supplier who uses child labor. Because they are using child labor and unethical labor practices, they might be able to get the material at a low cost. But sourcing material from them is not ethical. We should not buy materials from such suppliers. So these might lead to unethical behavior. Which one? Giving tight budget targets. Difficulties of changing budgetary practices. That means if you are already using incremental budgeting, now if I say let's switch to zero-based budgeting, there will be challenges if you want to change. Let's say you are using periodic budgets, now you want to change rolling budget, there will be challenges. You are using top-down budgeting, you want to change to bottom-up budgeting, there will be challenges. So that's what they say. Difficulties of changing budgetary practices. First one, resistance by employees. Employees wouldn't like. Whether it is good or bad, people like to stick to what they are doing. You offer something new, you show something new, they don't like to change. Loss of control. Loss of control means the moment you introduce something new, a new system, momentarily there will be a shake. There will be a situation that things are not so much under control because of the new system. It will take some time. Whereas old system you have been using for many years, it's all under control. The practices, policies, procedures, all are under control. But new ones, it takes time. Time consuming and expensive training. Of course, any new method you introduce, you have to train the employees. Cost of implementation, lack of accounting information. For example, if you want to introduce activity-based budgeting, that needs a lot of information. Activity-based costing needs a lot of information. I have explained that in ABC also. So sometimes your accounting practices in the past doesn't facilitate gathering such information from your records. So lack of accounting information, all these are difficulties switching from one budgeting method to another budgeting method. Let's see some more questions here. Which of the following statements regarding zero-based budgeting are correct? It is best applied to support expenses rather than direct cost, because direct costs, they are routine. That's what I explained earlier. Whoever the manager, whatever the decision, you can't change the material cost, you can't change the direct labor cost. So there you don't need zero-based budgeting. Even incremental budgeting would be okay. Support expenses like marketing expenses, IT expenses, these are discretionary expenses. That means managers decide how much, when, where. So this is where the justification becomes more important. Zero-based budgeting is more important here. It is best applied to support expenses. Correct. It can link strategic goals to specific functional areas. Yes, zero-based budgeting can be connected to strategy. That is true. It carries forward inefficiencies. No. That is incremental budgeting. Zero-based budgeting doesn't carry forward inefficiencies. It is consistent with top-down budgeting. No, it is more consistent with bottom-up budgeting, because the managers, operational managers, they have to explain, they have to justify every item in the budget. What is that? The managers are involving, right? It is participative budgeting or bottom-up budgeting, not top-down budgeting. Wrong. So 1 and 2 are right. Yes, the answers are 1 and 2. The following statements have been made about zero-based budgeting. Employees will focus on eliminating wasteful expenditure. Yes. Remember I explained employees will be trained to have a mindset of eliminating waste, because they know they have to justify everything in the budget. So this is true. Short-term benefits could be emphasized over long-term benefits. That is also true, because every year you forget about what you did in the last year, you focus on that year and see what best is for that year. So what will happen, you will not be able to develop any long-term plans, long-term strategies, long-term relationships. It's difficult. Very simple example. Every year you might keep changing your suppliers, because every year you might find a different supplier who is cheap. Zero-based budgeting says every year start from the scratch, find the best solution. So this way, every year if you keep changing your supplier, you will not be able to have a strategic alliance, strategic partnership with the supplier. So your long-term benefits might be foregone. Both 1 and 2 are right. Both 1 and 2. The following statements have been made about changing budgetary systems. The cost of implementation may outweigh the benefits. Yes, when you are changing, the cost might be high. What cost? Staff training cost. The lack of control might give you more cost. So yes, cost of implementing a new system might outweigh the benefits from that. That means the cost might be more. Employees will always, I'll give you a clue. Whenever you get statements with this word, always, read it twice, because most of the times they say always, the statement is wrong, because most of the practices, most of the principles we study doesn't apply always. There will be exceptional situations. So let's see here. Employees will always welcome any new system. No, employees don't always welcome new systems. They resist the new systems most of the times. So this is wrong. One only. Yes, one only. A budget is a quantified plan. Yes, this is in the definition. Quantified plan means whatever you include in budget must be in numbers. That means by the end of the budget period, we must be able to measure and check whether we achieved it or not. For example, you can say we would like to improve the quality next year. Now this is a qualitative statement. Why? You have not put it in numbers. Or you can say we will improve the employee satisfaction this year. How much? How do you measure it? So that is a qualitative statement. Now I make it quantitative like this. See, we will improve the employee satisfaction such that employee turnover rate will be less than 5%. See, I have put it in numbers. Employee turnover rate will be less than 5%. That is quantified. So if you are preparing a budget, every target, every plan you include must be quantifiable, so that when the year finishes, when the period finishes, we should be able to calculate and see whether we have achieved that or not. A budget is a quantified plan of action for the forthcoming period. Budgets can be prepared using a variety of different approaches. Which of the following statements regarding approaches to budgeting are correct? Incremental budgeting builds previous inefficiencies into the budget, whereas zero-based budgeting encourages employees to avoid wasteful expenditure. Absolutely right. Incremental budgeting builds in previous inefficiencies, whereas zero-based budgeting encourages employees to avoid wasteful expenditure is correct. Beyond budgeting uses adaptive management process. Okay, we did not discuss about beyond budgeting. What is beyond budgeting? We give budget to the managers as a guideline, as a comparator, as a yardstick. However, if you are practicing beyond budgeting principles, you give freedom to the managers to go outside the budget and do things, as long as they can justify their activities. So if it is not in the budget, but if the market demands such thing, customers expect such thing, if it will bring more stakeholder value, if it will bring more profit, managers have freedom to do that. This background is what you call beyond budgeting. So beyond budgeting uses adaptive management processes and plans on a rolling basis. Correct. Adaptive management process means management activities according to the situation, according to what the situation demands. That's correct. That's what you call beyond budgeting. That means the manager goes more than the budget, beyond the budget, and achieves the targets. Activity-based budgeting ensures that the budget is continuously updated by adding new. No, this is rolling budget. Budget is continually updated by adding a new budget period once the most recent budget period has ended. What is this? That is rolling budget, not ABC. That is a correct definition of rolling budget, not ABC. So this is wrong. Flexible budgeting recognizes different cost behavior patterns and so takes into account the organization's overall strategy during the budget process. First part is right. Flexible budgeting recognizes different cost behavior patterns. Okay, this is fine. But this is wrong. So takes into account the organization's overall strategy. No, flexible budget has nothing to do with the strategy. It's only about the uncertainty regarding the volume. So how do we deal with it? We take different volumes and we prepare the budget. So this part of the statement is wrong. Therefore, this is wrong. 1 and 2 only. Yes, 1 and 2 only. Ethical and sustainability considerations. Budget manipulation. Budgets are based on estimates. The better the estimates, the better the business will be. That said, employees are evaluated by comparing results to budget. Therefore, budgets may be manipulated to prioritize employee bonuses. Basically, this is where we have this concept of budget slacks. But is budget slacks? Employees might try to make the budget easy. If I know if I work hard, I can achieve 100,000 sales, I might like to put 80,000 as my target in the budget. So that target is easy. I can comfortably achieve the target and obtain the bonuses. So 100,000 target, which is a genuine target, but I try to put 80,000 in the budget, 20,000 I am keeping a slack for me. That is known as budget slacks. So this is the meaning of manipulation. This is ethical considerations, unethical as well. Employee bonuses over either the business as a whole or ethical considerations. Examples of unethical budgeting. Paying workers a wage that does not allow them to survive without state aid. That means paying very low salaries to employees. Why? You want to achieve profit targets. That's unethical. So managers might take, already I explained a couple of other unethical measures also. Buying materials from suppliers who don't have proper working conditions, who don't recruit the right labor, they have child labor and all that. So that is unethical. Clear? So this is all in chapter number 13 about budgeting. Then next chapter we are going to do some calculations regarding budgeting. That is where we will have learning curve, high-low method. We will see that in chapter number 14. Thank you.